Greed and fear influence your buy and sell decisions whether you know it or not. Hoping is gambling. And trading discipline is the foundation to healthy profits. We're talking psychology and trading. Let's get into it. Trying to grow your Forex trading skills? Then be sure to subscribe and keep up to date with our latest Forex trading videos, the perfect aids to your Forex journey. Hello everyone, and thanks for joining me, Simon, here at FXEmpire. When Forex newcomers start out, their first instinct is to focus on the charts. After all, charts are where the action is, with double bottoms, reversals, breakouts, and trends promising big paydays. How can a new trader resist? Unfortunately, this mentality punishes new traders, and they're suddenly shocked to find that winning trades isn't all that it takes to be successful. Trading is a head game. It's not the market you need to beat, it's yourself. Psychological habits build up over time and end up affecting our decisions and get in the way of long-term profitability. For everyone new to psychology, psychology is the study of the mind, behavior, and behavior patterns. Psychology is what makes us do what we do, and understanding it helps us overcome these mental barriers we set ourselves. In this video, I'll start by highlighting the most important lessons. After, I'll get into the juicy stuff, where I'll look into trading discipline and at the 8 key rules to successful trading. Let's get into the most important lessons. If you only take one thing away from this video, make sure it's that discipline is the key to long-term market survival. Without discipline, you run the risk of making bad choices based on some simple yet damaging psychological responses. Once that's drilled in, it's important to maintain it. The best way to do this is by writing down your trading rules. Putting these rules somewhere you regularly look, next to your computer, for example, is a great way of keeping them in the front of your mind. It'll be these rules that protect you from your own negative psychological responses, like greed and fear. Traders who let greed and fear control their buying and sell decisions are losing traders. Aside from greed and fear, knowing how to deal with loss is an important skill for a trader. Most folks have trouble taking losses, and if this is the case, you're not going to have a profitable trading career. A key factor in controlling this is all about limiting individual trade risk. If you're able to confine your trades to a small percentage of your total capital, you'll find these negative responses limited. After all, when less can go wrong, you're much less likely to make drastic decisions. Okay, let's talk a little bit about discipline. Discipline is a cornerstone of success. Discipline provides a set of rules that encourage good habits and discourage harmful behavior. When it comes to trading, discipline lowers the chances of self-inflicted losses, and I'll emphasize lowers. You can never totally get rid of losses. We're all human, prone to mistakes, miscalculations, the weatherman's curse. Still, having rules help us maintain an illusion of control over our positions. Discipline alone won't extinguish all greed and fear, the 2 strongest trading emotions, but it'll damn go a long way to help control them. So, how do we cultivate discipline then? Start by writing down a set of trading rules, then follow them religiously. Hell, if you need to start every morning by praying to your Forex shrine and reading your trading commandments, do that. Just whatever you do, get them down and stick to them. Doing this will help lower the impact of greed and fear. I'll cover the exact rules in a moment, but for now, just know that if they're not down on paper, they're harder to follow. It's psychological. Trick yourself into following them. Scribe those commandments in stone. They can be as simple as trading once per day, or as complex as entering a trade only when an instrument bounces from support after a bullish breakout confirmed by a bullish crossover in MACD and rising RSI. Rules can also help you avoid making blind trades in anger and frustration. Grudge or revenge trading, trying to get back at the market with wild bets, are real ways to lose your trading capital. For example, don't just short Tesla because you have a grudge against Musk dropping Bitcoin. You're not a billionaire. Don't try to change the market. Go with it. It's always good to have a starting point for rules. So here are a few I like to stick to. You don't have to follow them, but use them as a template. 1. I will risk no more than 2% of my capital on a trade. Trading in small amounts dramatically reduces the pull of greed and fear. Using a percentage instead of a fixed amount allows investment size to grow or shrink depending on your account balance. 2. I will always trade with the trend. I will determine trends by price action, trend lines, moving averages, and momentum indicators. This encourages us not just to learn trading techniques, but to not make seemingly random trades based on gut feelings. If the trend is going one way, the trader should assume the trend will continue. 3. I will only enter on confirmed long and short entry signals. My signals are bullish or bearish crossovers in relative strength and momentum indicators, confirmed by a breakout or breakdown of the 50-period moving average. Your signals can be whatever you like, but make sure they're informed. Link to Rule 2. This rule gives us a framework we can rely on when deciding to make trades or not. If all the boxes are ticked, trade away. 4. I will not enter if price action is within 3% of resistance for a buy trade or 3% of support for a sell trade. Prices naturally define themselves and end up with a top and a bottom. While these can of course be broken, once they've been established, they can be pretty reliable indicators. If the price is close to the floor or ceiling, hold. 5. I will use support and resistance as exit targets. If the price reaches a target, I will exit to take profits. Some profits are better than no profits and infinitely more satisfying than losses. Set your targets and don't get greedy. While it may seem exciting and possibly fruitful to hang on tight, markets can change fast and all those profits could disappear. Set a target and stick to it. 6. I won't have more than one trade open on one asset at a time. Don't keep buying the dip in an attempt to make more money when it swings back up. Having only one position on an asset at a time will ensure you're not throwing all your capital down a well. 7. I won't have more than 5 trades open at the same time. 8. I will always follow my rules. The last rule is the most important rule. It doesn't make sense to have rules if you're not going to follow them. Make your list and be stoic about it and stick to them. Yes, sometimes you may need to stray from the path, but only do so after great consideration. After all, there are only a few reasons why you may stray from the path, and most of them stem from fear and greed. Our often unconscious emotions can push us into bad decision-making. That's why, when trading, if you take emotions out of the equation, better decisions, more consistent wins, and capital preservation will naturally follow. Let's take a look at the biggest psychological factors. Number 1, fear. One of the market's most vicious emotions, fear, can keep you from making a good trade or from taking a timely profit. Fear of losing money will keep you awake at night, but don't let that stop you from trading. The solution: keep trade sizes small so no single loss can hurt you that badly too badly. Doing this will alleviate a lot of that primal fear. Number 2, greed. Greed, the other face of fear, can be just as damaging, but tends to be harder to control thanks to the positive feelings. Greed is the fear of losing profits you don't have, or the desire to make big trades and take even bigger profits. Greed rears its ugly head when we're doing well, taking most of us by surprise. In its most common form, profits build confidence beyond the current experience level, invoking greed that encourages over-aggressive trades and excessive leverage. Be humble. Be modest. Be controlled. A cathedral isn't built overnight. Ambition, a required trait for long-term success, but a noose around the uncontrolled trader's neck. Admittedly, it takes a ton of raw desire with a side helping of adrenaline to succeed in the financial markets, but ambition becomes dangerous when you let it cloud your judgment. Comparing your results against another trader's performance and letting that influence your decisions offers a perfect example of runaway ambition. You're your own person and will get to where you need to be when the time is right. Loss is an inevitable part of trading, but can be managed through rules and discipline. The goal is to take appropriate losses while avoiding catastrophic career-ending losses. Position sizing, so the 2% rule, is the key to loss management. Be sure not to get blinded by greed or fear and throw money away. Walk away if you get frustrated from a string of losses. Don't just keep buying the dip. Dip buying will ensure you end up tying up all capital in a bear market that may potentially last years. Hope turns against you when the ticker tape turns against you. It makes sense to hope that your hard work pays off, but the train goes off the rails when you start hoping a trade pays off the mortgage, pays for a vacation, or saves a marriage. Hope is the difference between gambling and trading. It's a perfect way to lose your trading stake and wash out of the Forex market. Negative psychological traits and their impact on trade decisions need to be studied and mastered to succeed in the Forex market. Putting it bluntly, emotions need to be removed from Forex decision-making if you want to be profitable in the long term. That requires establishing specific rules, the discipline to follow them, and the ability to walk away when things get rough. Thanks for watching, everyone. Don't forget to like and subscribe if you want to continue to learn and grow as a Forex trader. Have you made any bad decisions on the basis of fear or greed? I know I have. Leave us a comment below so we can all learn from each other's mistakes. See you in Part 5, Benefits of CFDs. Stay strong out there, traders.